Hello and welcome to the video for valuation. In today's video, we'll be answering the question, how do we assign value to our business and assets? And to do that, we'll be looking at two separate valuation methods, the first of which is a discounted cash flow model, which is an income-based approach. And we'll also be looking at market multiples, which is a market-based valuation approach. As well as in this video, we'll be looking at a calculator. So we'll have a breakout video for that, how we use those cash flow keys to do a DCF valuation. And we'll also be looking at a value known as net present value. So to begin, we'll first look at the definition for a DCF valuation. And simply put, it's the valuation method of estimating value by forecasting future cash flows and discounting them for rate and time. So to do this type of valuation, we first have to project our future cash flows and discount them for rate and time. What we're talking about specifically is, if you'll remember, when we're looking at future cash flows, the value of money in the future isn't exactly worth the same that it is today. So we'll look at how we adjust for the longer time periods or the further that we project our cash flows out, using specifically a rate that we use to discount those values. So what we'll now do is look at the step-by-step process of building a DCF model. And the first thing that we'll want to take a look at while building a DCF is the rate that we'll project our cash flows to grow during the short term. So there's a couple different ways that we can look at growing our cash flows in the short term. We can grow them by a growth rate, which will be a rate which is only through our explicit growth period, so the short-term period that we're looking at growing those specific cash flows. Or we can just assume that the cash flows will be constant over a given time period. We'll also want to know how long we're going to project the asset will give us cash flows. So this could be considered the useful life of an asset. And at the end of the useful life, we may be able to sell the asset for a salvage value. But we'll want to know exactly how long we're doing those cash flows for. We'll also want to know what rate we'll discount our cash flows at. So this rate could be a couple different things. The first is this could be the cost of capital to acquire the asset. So that would be the percentage potentially that we have. We're looking at financing either through debt or through equity, the percent return that we're having some requirement on for that time period. Or we could have a hurdle rate. So this could be a rate that our investors hope to get in return for their investment. So potentially you're getting money through equity from some sort of investor and they're requiring, say, a 10% return on an investment. We could use that percent return as the rate that we discount our cash flows at. So then we'll also want to know how much the project will cost. And so we'll use this to identify if the project will actually give us positive cash flows. So when we're doing this calculation, when we start to look at net present value, the cost of the project will be important. So now in this section, we'll take a look at how we use a DCF. So we'll run through just a quick example, get some numbers, and actually get to that calculator that we were talking about earlier. So we'll start off, let's say that the Computer Services Inc. would like to purchase a new machine for $10,000. And they believe that once they get the machine up and running, that it will be able to earn them $3,000 a year over the course of 4 years, at which point they plan to sell the machine for $1,500. We also know that the Computer Services Inc. does not have the cash on hand to purchase this asset by themselves, and they look to investors to help fund the project. So if these investors require an 8% rate of return on their investment, should Computer Services Inc. purchase the machine? So it's important to pull from that example is that the purchase price of the asset was $10,000. The projected cash flows were $3,000 a year. The time period that we're going to have for our explicit period was 4 years, at which point we'll have a salvage value of $1,500. And the investors had a required rate of return of 8%. So now we'll do a quick run through of what we'll be typing into our calculator. At the end, I recommend that you go ahead and pause the video or take a screenshot, just so you have the directions available for you, as well as we will have a video showing on an online version of the calculator how to run through this equation and get to a net present value. I'll run through this very quickly for you. You'll make sure first that you set your calculator to 1 payment per year. you'll enter in negative $10,000 and hit the cash flow key, which will assign the cost of the machine as our cash flow in year 0. So we're just making sure the year 0 we actually show the cash flow going out. So negative $10,000. And then we plug in the $3,000 for the next 3 years. So I'll touch on very quickly. It's important the 3 years have $3,000, and then we'll see in this 4th year, the cash flow will actually be more than $3,000. Because 3,000 is the amount that we're getting, and year 4 is our last year, we also have to consider that salvage value. So what we'll do there is we'll add on that salvage value in the last year because that will be a cash flow coming into the company. So I'll be actually $4,500 for that last year. And then we'll go ahead and apply our discount rate of 8% by typing 8 and hitting our time value of money key for our interest rate over the year. And so once we plug all that in, we hit the second key, calculate net present value, and that should be around $1,038.93. So that value that we got was a net present value. So we need to look at what net present value means to us as a company. And really just the definition of it is it's the difference between the discounted inflows and outflows of cash. So when we're talking about the inflows of cash, it's those $3,000 as well as the salvage value at the end of that 4th year. And all of those cash values are discounted each year. And those are the positive amounts that we have coming in, net the cash that we have going out for actually purchasing that asset. So net present value is just the addition and the subtraction of the inflows and outflows of cash as they've been discounted for rate and time. So using that last scenario, we could conclude that the project would net our company or Computer Services Inc. $1,038.93. So in this section, we'll take a look at market-based valuation. We'll look at the definition and what it means, but we'll also take a look at an example on how we would actually go about using market-based valuation. So we'll first take a look at the definition. The definition for market-based valuation is that it's really just a way of valuing a business or asset by looking at comparable transactions within the market. So I like to liken the market-based valuation approach very similar to buying or selling a home. When you're looking at purchasing a home, you might notice that houses with relatively the same bathrooms, bedrooms, or square footage within a certain neighborhood, or maybe even a certain region of a city, go for relatively the same price. So market-based valuation is doing kind of the same thing as we're looking at purchasing or selling based on comparisons. So what we'll see is that when we're not looking at square footage or bedrooms on a business, we're looking more at key metrics. So those could become revenue or EBITDA or really just any variable that's a good indicator within your market. So if you're working at a company that has high revenues but not a lot of cost of goods sold, so potentially you're an online business, you might use a revenue-based multiple versus a company that is in the process of manufacturing a good where they do have large cost of goods sold. So you might look at EBIT or EBITDA multiples. It just depends on your business, specifically within its marketplace, and just how it operates, which market or which multiples will be the best to use for a market-based approach. So now we'll take a look at how we use market multiples. We'll go over just a quick example. And so let's say the Computer Services Inc. would like to acquire business, but they don't know what a reasonable price of acquisition should be. And further, they're looking for a similar sized company within the same industry as the business that they're trying to acquire, and they find that a recent transaction has, from that comparable company, revenues of roughly $500,000, and it's sold for a price of $1 million. So how they would calculate that multiple, the equation I have here is the price of the company divided by the variable that we're looking at. So we're creating a multiple for that variable. So in this case, we have revenue and price. So we'd be creating a revenue multiple. So our variable again is revenue. Price, $1 million, variable revenue, $500,000. So our multiple then would be the $1 million divided by $500,000 to get a multiple or a revenue multiple of 2 times. So then if we do further analysis and we find that the company that Computer Services Inc. is trying to acquire has revenues of roughly $650,000, we can take that multiple of 2 times and multiply it by 650,000 to get a rough estimate for acquisition, or at least the price of the company should be around $1.3 million.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.